Hello, everyone, and welcome to Binance VIP Voices. Before we start, a small disclaimer. As a reminder to everyone here, digital assets are subjected to high risk and price volatility. This means that the value of your investment might go up as well as down, and you might not get the investment back. You're solely responsible for your investment decisions, and the conversations taking place here today do not constitute investment advice of any kind or endorsements or recommendation to trade in any digital asset. That being said, my name is Michela and I'm your host for today. I'm a business development manager at Binance VIP and institutional team, and welcome to our very first episode at Binance VIP Voices. This is going to be a new conversational series hosted by Binance VIP and institutional. Voices are a space where we will be able to delve deep into the minds of the biggest institutional players and thought leaders in the industry. We'll be covering a variety of topics in the world of digital assets, such as institutional adoption, institutional trading strategies, crypto asset management, and a lot more. Binance VIP and institutional caters to all types of institutional clients. We work with a wide range of market participants, including individual traders, high-frequency trading firms, proprietary trading firms, hedge funds, asset managers, family offices, market makers, brokers, investment banks, corporations, fintechs, and more. The Binance VIP program offers multiple pathways for sophisticated digital asset traders, investors, and market participants. There are 4 subprograms: Trader VIP, Holder VIP, Investor VIP, and Borrower VIP, designed to meet different types of needs. If you would like to get in touch, you can email us at vip@binance.com and let us optimize your digital assets journey for you. The moment has come to start this episode. I couldn't be more excited. Without further ado, our first guest is someone that has over 30 years of experience in hedge funds and asset allocation and has been involved in digital assets since 2012. Before crypto and digital assets, he ran Goldman Sachs hedge fund sales in equities and equity derivatives business in Europe. And he also manages a 500 million global macro hedge funds. He is the founder of the Global Macro Investor and the co-founder of Real Vision. Well, for the announcement, Raoul, welcome, and such a pleasure to have you as a guest in VIP Binance Voices.
Great to be here, Michela. Thank you for having me.
Our pleasure. Raoul, would you mind giving the audience a glimpse into your personal story, career background, and your current projects?
Yeah, so there's quite a lot to this. My background was 30 odd years of finance. So I was at Goldman, as you mentioned. Then I ran a large global hedge fund for GLG partners. After that, I opted out of the rat race and moved to the Mediterranean coast of Spain because London has terrible weather and Spain was much nicer. And I started writing macroeconomic research and investment strategy for the world's largest hedge funds, family offices, sovereign wealth funds, that kind of stuff, asset managers. And I was there and luckily predicted the financial crisis in 2008 and then the European debt crisis in 2012. Those were 2 really huge moments for everybody to understand how broken the system had become. And also that there was a lack of trust in the system. Ordinary people, the rise of Occupy Wall Street, realized that something was going on that they were not in control of and that they wanted answers and they wanted to do things themselves. That put me on a couple of paths. One was, okay, people are now on their own. They need educating. They need to be given the information. So I started Real Vision, which the idea was, okay, how do we democratize the very best financial intelligence and give it to everybody? And that was, we started off, what doesn't seem very innovative now, but we were the first people ever to do long form financial content, interview the world's most famous hedge fund managers, analysts, strategists for an hour and pick their brains and to find out how they're thinking about things. And that allowed people to learn and to have an understanding and to kind of collapse those walled garden that is the financial markets and opened it up for everybody. And Real Vision for the last 14 years has been building on that passion to help people. Also in 2012, during the European crisis, I realized that none of your money in a bank was safe, and that most of the financial system was built on so much leverage as well, and nobody knew who owned what. And I thought, this is a real problem. And I'd gone around the world trying to start a bank, actually, at the world's safest bank at the time, which is not an easy thing to do. And while I was struggling with that, with regulators and all of these people, somebody said, "Hey, have you looked at Bitcoin?" And I saw Bitcoin and realized, okay, here's a digital asset that can be thought of like gold, but this blockchain allows us to have the recorded ownership of everything in this distributed manner, and that was very powerful. That started that journey for me as well. So I became an investor. I wrote the first ever macroeconomic strategy paper on Bitcoin in 2013, and was an investor from then onwards, and have been on the whole journey. My thesis was that these two worlds of the new world of digital assets, blockchain technologies, and the financial world were going to meet. And so we were educating people in Real Vision, and I had been part of this journey, learning from as many people as possible. 2020, they all met in a spectacular way. And people realized that the financial system and the printing of money and so many other problems could be solved by this new technology. And now it's become much more commonplace. That led me to start another couple of businesses, because I started building a hypothesis of not only that this technology is going to get adopted in many ways by individuals, but institutions are going to want to invest in it. And right now there was a lack of product for them. And also that corporations and brands were going to build on it for the future of marketing, loyalty, brand engagement, community, and a lot of the other benefits that come with Web3. So I started Exponential Age Asset Management, which is a fund of hedge funds that invest in digital asset hedge funds to capture the opportunity for institutional investors, family offices, high net worths, who find it complicated to invest either in VC, because sometimes it takes 10 years plus to get any money, and also in individual hedge funds, because individual hedge funds are riskier than a basket of hedge funds. So we thought, I know this, I know how the industry does it, so we'll do that. And the crypto industry is already slightly starved of capital. There's not that many secondary market participants, and after this cycle, a lot of the trading firms have closed down. We need a larger group of secondary capital. It can't just be retail investors. So that's that idea. And then on the other side, Science Magic Studios, we've been talking to many of the world's largest cultural brands in the line of music, entertainment, fashion and luxury goods, and sports, where we think Web3 can really help.
Well, after such an intro, I think we can all agree that Raoul's career journey is in a league of its own. I will say it's really an honor, Raoul. Without holding back our audience any longer, let's step into the heart of this episode. The first question will be, we are very, very interested in hearing your perspective on the major differences from an institutional standpoint, of course, between trading in traditional markets and trading in the crypto markets. What are the most critical differences, in your opinion, between the two?
In the end, all markets are the same. They're prices of which, products are offered, whatever you want to invest in, and there are exchanges or brokers that offer them. So at essence, they're the same thing. They just happen to be more volatile than assets that most people are used to investing in, because they're earlier stage in their growth cycle. It's kind of like liquid VC. So it has more volatility. Anybody who's invested in a startup and speaks to the founder of a startup, one day they're going bust, the next day they're going to be billionaires, the next day they're going to be bust. And that's how crypto markets are, because you're early stage. So it's before you've got the large products, before you've got product market fit, all of that stuff. So it's riskier, but you're more than compensated in the returns over time, or historically have been. And therefore, I've spoken to many institutions about this, and they understand that this plays a role in a portfolio. It's actually a portfolio diversifier over time, and can actually dampen risk of the overall portfolio and give further upside. So if you put it into a standard asset allocation model, you tend to find that Bitcoin, ETH, or a selection of these can do extremely well for a portfolio and still dampen volatility. So yeah, it's a very interesting area. The only difficulty is obviously regulatory clarity in the US has been less than in other countries. So that's been difficult, but that doesn't really apply to the institutions as much. The hedge fund industry is still pretty nascent, doesn't have a lot of money in it. So there's less liquidity, I guess, is the other issue. there's not yet the sort of liquidity they're used to from equity markets or commodity markets. It's a smaller market still. It's still, $1 trillion, and those are all hundreds of trillions of dollars markets. There are single equities like Apple is worth 3 times the entire market cap of crypto, and that's just one company. So you're dealing with something that's less liquid, more volatile, has a potential over time to accumulate better rewards, but it comes with the risk of the kind of volatility we get used to. Once you've been in the space for a while, you realize that it's pretty normal every 3 or 4 years that it all goes down 70%. When you zoom out, you realize it's gone up 500x over that time period as well. So
yeah, no, cryptocurrencies are definitely still evolving. And taking into account this state of evolution, this takes me to the second question. How do you think macroeconomic shifts have influenced institutional crypto trading strategies over the last 1 to 2 years, or the major strategies transformations that you can recall alongside that state of evolution?
Well, in terms of what is driving institutions to look at crypto, I think they understand the issues of the financial system. I think most people understand how much debt that there is. The US, the largest economy in the world, the government's over 100% of GDP in debt. The private sector is another 120% of GDP in debt. The financial sector is another 200% of GDP in debt. The world is 400% of global GDP in debt. I mean, these are staggering numbers. The world has never had this much debt. They are also aware that brings fragilities. We see endless banking crises around the world that roll on and on and on because of this very issue. And then they became very aware of monetary printing and the impact that has as well. So almost every institution that I speak to, whether that's a hedge fund or a pension fund or an asset allocator of some sort or a sovereign wealth fund, understands this. So the question they then ask themselves is, how can we not have an allocation to crypto? So by the time they got to that point, because these are slow moving and they have a lot of work to do internally to get the approvals, what you tend to find is the cycle ends and everyone's like, whoa, they kind of are aware of the volatility. So I don't think it scares them as much, but they just now want the confirmation that the volatility is out of the way and the next phase is coming. So that was the big thing that I saw in this cycle versus the previous cycle. The previous cycle, we saw some participants coming on, people like Fidelity. They started to come into the space. Some of the bigger hedge funds like Brevan Howard had come into the space. Soros, More Capital, these giant hedge funds, they all explored and invested in the space. This time around, the 2021 period, pretty much everybody did the homework. And you'll have seen it at Binance. Everybody's seen it. They've all had a lot of conversations with all of these people. Family offices became much more involved this time around as they understood it. How can they preserve wealth in an environment where the central banks are printing currency? How can they preserve wealth in an environment where where you don't know if you can hold on to your assets if a banking system goes under, that kind of issue. So we've definitely seen that. We've seen the rise of, on the trading side, we've seen the rise of more traditional hedge funds investing in this space. So the large asset gathering hedge funds have all traded in the space. They're still not yet comfortable with the volatility. Some of them are, some of them aren't. Others span off whole hedge fund units like Brevan Howard. So Brevan Howard Digital is a giant in the space now. And I think we'll see more of that. Because the return profile is different and it's harder for the regular investor to get, if not the book is quite small. But we're definitely seeing a lot of interest from that. They pulled back a bit because of the bear market, but that's their job. Their job is to allocate assets. They don't have to be crypto believers all the way through. They need to be gunslingers who look for capital opportunities. But most of those have done the work and will come back into the space. The crypto hedge funds, there's a lot that always launches at the peak of the cycle. And then at the bottom of the cycle, a lot of them don't work, but the better ones survive and thrive. And we see higher and higher quality people coming out of the traditional hedge fund industry and out of the top investment banks like Goldman Sachs come into the space. Then we've got on the banking side of the equation, all of the big banks have large crypto teams. Not yet so much for trading, but building blockchain technologies, the securitization of putting assets on chain, but also ready to make prices, to market make, to offer products to clients. they're all doing the work as well. So I see all these. Well, I know it's very difficult for most people because all they see is price go up, price go down. But I see what's going on behind the curtain, and this freight train of everybody moving towards this is happening.
Yeah, I was just about to say that it's interesting to see this through your eyes, because retail traders keep this conversation alive on social media with a totally different angle, as you said, addressing fundamental analysis and market shifts from their eyes. But what really captivates me is exploring the impact of those macro shifts in trading strategies through the lens of an asset manager like you. Now, Raoul, building upon the same train of thoughts, what are institutional investors, or how are institutional investors shaping their strategies to realign their portfolios allocations to potential opportunities in the space in 2023 and 2024? How are they making those changes and preparing for what's coming?
So I think they've done a lot of the preparing. They've got kind of approval to allocate. Many of them put their toe in the water in 2021. There was a lot of institutions that got involved, and really they were in the learning stage. And what I've found is a lot of those institutions have now built large teams, looking at what they can do about, like, even tokenizing their funds as well. You know, we've seen people like Franklin Templeton building out huge teams to do that. Fidelity have built out huge teams. So there's lots of people doing that. The next phase for these guys is, okay, we understand it. How the hell do we implement it? And this is where it gets harder, because they then have to go and say, okay, do we need to open a multi-sig wallet? Do we want to hold it in an exchange? How do we do this? And obviously there's no ETF, which is one of the things they're waiting for, particularly the investment advisors and the smaller pools of capital. They don't have a vehicle that's easy for them to pass their traditional risk management systems, because they're not used to self-custody assets. Right? There's not many self-custody assets. Most of them don't self-custody gold, even though they may have gold. They use the ETF as the easier way to proxy, because they don't want to self-custody. So they're all figuring out what the way to do this is. Many of them did VC. So we saw record amounts of VC, 65 billion over 2021, 2022. So that was their way of getting started. Now the next phase, I think, is the more liquid markets. So some own Bitcoin directly, for example. Seen that a lot of family offices do, Bitcoin, ETH, and a bunch of others. We're seeing that. I think we'll see the rise of new products, which is stuff like ETFs. I think we'll see a rise of a structured products market. Now there's more of an options market. So we will see these guaranteed products that have been very common in Europe and Asia over a long time. The next phase, I think, that is very interesting is this time around, they now have an asset that has a yield, which is ETH. And so they can have a yielding asset that also has the risk return profile of technology. So it's a very interesting thing for them to do, because if you're a pension fund, you actually need a yield to pay the pension payments. So it becomes very interesting for them to have an asset, unlike gold, because gold doesn't have a yield. It has a yield. Most tech stocks don't have a yield. So I think there's a phase of people now looking into, okay, how can we hold this asset as well into our portfolio? What does yield in crypto mean for us? It's likely to mean a higher ability to own assets in the space. So there's a lot going on. Then there's businesses like I've got built with XPAM, is to give them other alternatives, which is the hedge fund market. So you're basically a hedge fund. What you're doing is farming out the ability for other people to take the risk for you using their own expertise. So, you know, how to manage the risk, how to capture the alpha in the space. So I think we'll see that hedge fund industry grow massively. It's still very few large funds, quite a lot of very small funds. And the whole space is maybe $5 billion, $10 billion versus the traditional hedge fund industry, which is $3 trillion. So I think we'll see a lot of capital flowing into that space as well.
No, great angle. Just to make a quick note, how can people contact you regarding spam? Is there another an email they can message you?
Just go to XPAM, EXPAAM for mother, xpam.com. The website's there. You can read some details, and again, it's for high net worth investors, institutions, family offices, that kind of stuff. It's not for retail investors.
Noted. Raoul, let's now pivot our conversation to the matter of adoption, specifically to the pace of adoption. What do you foresee happening in the crypto market with more institutional players joining the space? How will you rate the pace of adoption for the rest of institutional players? I mean, for the years to come, how would you, if you had to draw that exponential curve, how would you describe it?
So I think this next phase, so the next bull market or the next business cycle, will see a mass onboarding of institutions. I've seen this space before. Usually it's the family offices are first to take risk. And we've all seen that in the space. Many family offices were the first to invest because they're freer to do what they want with their own capital. As I said, most of the institutions have done work, including the investment banks. And so now they just need price confirmation and then they'll be in. So I think we'll see a lot of that. Now, that kind of makes sense because the asset class at peak was 3 trillion in 2021. It's almost impossible for retail investors to continue the pace of adoption. It needs the institutional capital as well, which drives out the ongoing adoption curve. So, my view is still by the end of this cycle, the space is probably 10 trillion plus. And that happens because of the institutions coming to the space, offer more products to their clients. So institutions coming into the space tends to mean that BlackRock offers a product to their network of advisors. So it allows more money to come into the space via different mechanisms, i.e. aggregated mechanisms of funds, as opposed to individual accounts being open on Binance, for example. So it's just different methodology, but it's just the growth of the capital into the space.
Yeah, and now that you mentioned this adoption by institutional players, I do think that these can potentially trigger a chain reaction of effects. And one area where this impact is particularly intriguing is correlations between different asset classes. Historically, traditional markets have exhibited correlations that often align to economic indicators, geopolitical events, and overall market sentiment. However, the growing involvement of institutional investors, especially within the crypto ecosystem, introduces, I will say, a new layer of complexity, right? So, Raoul, could you provide some insights into the key intermarket correlations that institutional investors closely monitor when analyzing digital markets, and how those correlations help them to make more informed decisions when managing their portfolios?
I'm not sure they yet fully understand how driven by the business cycle and the liquidity cycle crypto is. But I think they know that you could extrapolate all the complexity away, and it's like, if it's risk on for assets, people want to own technology stocks, crypto will go up more. So I think they understand that basic premise. And when the cycle slows down, crypto goes down more. That's the volatility cycle. But over time, the returns compound. So I think they understand that. And as I said, I don't think it concerns them. It's a matter of position sizing for them to make sure it fits within the portfolio. And the structure of markets, I don't think it dramatically changes because the business cycle essentially rules everything. That's the risk taking, the credit cycle, and all of those things. So it's the same thing is when they get ready to allocate to risk. Now, if you look at surveys right now, most institutional investors are still underweight equities, even though they went up a lot. I mean, the NASDAQ almost got to all-time highs. Most of them haven't participated. And that's the same with crypto. They've still got this nervousness about recession, inflation. What are we supposed to be doing? I don't want to make a mistake. But sooner or later, they get comfort, and you'll see them going up the risk curve with equities, and then eventually they'll follow with the digital asset side of the equation. And that's very typical in most markets. You see the same in junk bond markets, emerging markets. And I would put crypto, if you want to think of it simply from a traditional asset manager, it's a high-tech emerging market. I mean, that's what it is. They're volatile, but they tend to massively outperform when GDP growth is positive. And they outperform even more when the central bank is printing money.
Yeah. And now, Raoul, let's steer our conversation toward the biggest investment banks and financial giants. In the last few months, we have seen the biggest investment banks relaunching their trading desk, as you said at the start, as well as new exchange traded products. What is your outlook on the financial institutions, on the role of those financial institutions in 2024 and beyond? Um, how do you perceive those financial institution strategies evolving to provide innovative products catering to qualified investors specifically, not to retail, but to accredited investors?
It's bigger than all of that. They understand and fully understand that it's a wholesale change to their business model. They need it to happen slowly because there's a lot of work to be done, but it's happening and they know it. For example, a friend of mine used to be at one of the biggest banks in Australia. He was one of the senior people running treasury and credit and trading and risk. And he's like, I spoke to him after he retired recently, and he said, well, we've been spent the last couple of years working on stable coins. I'm like, why does an Australian bank need stable coins? And he's like, oh, we've done them in 5 currencies. I'm like, is this for retail? Why are you trying to do that? He's like, no. He's like, the US equity market is going to go from T+3 to T+1 settlement, which means you settle the following day for the trade that you did. He said, we're in Australia. We have to do foreign exchange transaction, and we've got this happens overnight for us. Foreign exchange markets are T+2 or T+3. He said, we can't settle our trades. So we have to have a stable coin to settle the trades with our US broking entities. So you're realizing that they're going to blockchain to solve just infrastructure issues like that. But these are gigantic. These are hundreds of billions of dollars of transactions a day or a week. They're huge, but they're seeing it everywhere. So the investment banks are all testing putting securities on the blockchain, bonds, credit. They're looking at how can we use NFT technology, which is really just a contract, for the derivative market. Why can't OTC derivatives be on chain? They're looking at all of the exchanges are looking at, should we use blockchain rails? So all of them have got teams. That's the London Stock Exchange, NASDAQ, everybody's got teams. Australia recently closed down their team, but they've been working on it for a number of years. We know that even the Middle East are talking about it. So everyone's thinking about, can we move our exchanges to blockchain rails because it's more efficient, it's faster. They're saying, how do we make our payments amongst ourselves, cross-currency payments? How can we do that using digital rails? How can we offer products to our customers around digital assets? So that's offering hedge funds liquidity and options or swaps markets and other things. How can we offer our asset management firms structured products, guaranteed funds, those kind of things? They're seeing that too. So they're seeing it at every level within their businesses. They also know that central bank digital currencies are coming, and they need to think about integration of that too. So they're seeing it infrastructure layer, product layer, and customer layer all at the same time. And people like Goldman have been doing this, building in this space since 2015. So again, a lot of people don't notice or know this because it's so many people are retail participants, but pretty much everybody, including JP Morgan, and I go and speak to like Franklin Templeton. You wouldn't have thought of them as cutting edge, but they've put a money market fund on the blockchain. They were the first people in the world to do that, which is a different angle of stable coins. And they've been working, they've got a huge team there working on that. The team at Fidelity, looking at what they can do within their business. I mean, when they started it, they started doing Bitcoin payments for coffee in their cafeteria to understand how it worked. All of these people run their own mining nodes. They run the validators. I mean, they do everything. And I'm seeing that globally. We're seeing in the UK, the banks are behind, but the government is obviously moving quite fast forwards, and the fintech sectors everywhere as well. They're kind of all working together. So yeah, there's a huge momentum. So again, if we step back, most of us just see the Twitter retail markets, but we've got this hedge fund market that's building, getting more mature. we're seeing the investment banks building out everything that needs to be done in the financial system. And we've got the asset management firms getting ready to offer the right products to customers. And everybody else doing the work to invest. So when I look at that, it's like, makes me kind of proud, right, to see how far we've come, because it always feels pretty difficult once you've gone through yet another bear market. I mean, I've seen a few of these, right? But when you actually step back, you're like, yeah, this place is growing up fast.
Yeah, I know it's a very interesting point. As you said, those 3 layers. I haven't heard about that before. Hope everyone is taking notes. This is years of knowledge condensed in one episode. Well, I think now before we continue to all of those that have tuned into this episode, I would like to extend a warm invitation. Now, feel free to share any questions that you might have for Raoul, as we are about to address a selection of 2 or 3 queries shortly. Please kindly share your questions in the chat. And that being said, Raoul, jumping in my next question is, what role do you see digital assets playing in diversifying institutional traditional portfolios, and how do they complement those the ones that we see in TradFi? If we consider an asset manager, let's say, stepping into the crypto market for the first time, are there any particular aspects of portfolio equilibrium that they need to factor in?
So I actually, in 2020, I think it was, I asked one of our Real Vision members, who was an expert in building asset allocation risk models with systems like Barra. There's a whole bunch of these. And I said, listen, can you look at Bitcoin properly for us? And how does it work on the kind of efficient capital frontier? How does it fit into the model? What does it do? Now, I don't have that paper at hand, but essentially, it depends where you put it in the portfolio. Most people don't have digital asset as a risk bucket. So they either decide, did they put it as FX? Do they put it as VC? Do they put it as what? So that's one of the harder thing is, how do they fit it into the internal risk system? But what we found, that even though it is the most volatile asset in their portfolio, actually in a portfolio itself, it dampened the volatility significantly while offering huge excess returns. And we found that somewhere between 5 and 10%, 10% you get a lot more risk, 5% you're really at the efficient market, and it's really adding a lot, because don't forget, 5% is not much of an allocation to the S&P, but if crypto markets repeat the kind of performance, they can go up 5x, even Bitcoin. And so that's a lot of performance for the underlying pensioner who's got the policy or whatever. So it fits in very well. And I understood this because I've seen this all before. And that was I was at Goldman when the commodities group built the GSCI, which was a commodities index. No institutional asset managers had commodities in their portfolio. Didn't fit in their risk models. What bucket do we put it in? Do we put it in as a currency? It was the same argument. And the team went around and educated everybody on the benefits of portfolio diversification by adding commodities in. And that product went from 0 to hundreds of billions of dollars as the institutions understood how it worked. That's one of the things that I've been very keen on, is whether we like it or not, a lot of the traditional asset management firms don't really understand or speak the same language as those of us who are more native to the digital space. But if the Goldman Sachs asset allocation team sits down with them and shows it to them and puts it into their models and say, we can custody this or prime broker it, they'll do it. No. And I think if we go back to the conversation we had about these investment banks building teams, that's what these teams are going to do, is they will provide the comfort, because these guys want to go to they want to show that they've taken their fiduciary duty seriously and go to their investment committees and say, well, Goldman's built the asset allocation model, or JP Morgan have helped us, or Morgan Stanley have helped us. This is what we believe it to be. And that's where they get the final layer of comfort. So the models do show very much that it's very accretive to portfolios. And even in small sizing, it can make a huge difference. But the issue is, as I said, they don't know where it fits in yet. So that's the trickier part.
Noted. Noted. I have right here our first question. And the first question I have is from one of our asset managers connected to Binance is, how is, for an asset manager that has been trading, let's say, FX for a while, how would a good practice is to run the strategies that he has been running on FX in crypto, both systematically and manually? Is this a good practice just to start, just to test the market? Will you recommend that? That's his question.
If you're trading kind of super liquid FX markets, I don't think it's a great strategy. If you look at who has been successful coming out of the investment banks and other hedge funds into the crypto space, they tend to be emerging market currency people. And the reason being is gap risk. These markets can be very illiquid when you need liquidity because there's not enough capital in the space. There's not enough hedge funds. There's not enough investment banks, right? There's a small number of participants. So that means that models that work well when you're trading dollar yen just won't work in crypto when things go against you. So I think you have to understand liquidity constraints. But look, overall, markets trend. So market trending strategies tend to work very well. You've got many of the risk arbitrage strategies work well. Most of the people we're seeing in the quant side tend to do quite well in this space. So I've not seen a huge struggle for models driven people. The harder one is the thesis driven directional, because it's like macro directional. It takes a lot of risk taking skill and stomach for risk. But these assets are very, very liquid. So you need more understanding investors. So a lot of the time it's actually managing your investors. You need to explain to them, this is a more volatile asset. So if you know our strategy from FX and it had this volatility profile, well, 5x that. So it's a matter of expectations management as well, and also thinking about liquidity. But overall, systems work across most markets.
Yep. Yeah. The second question on the line is, you as an asset manager, how long does it take you to backtest a strategy before actually deploying it in your own fund and offer it to potential external investors?
So we're a fund of hedge funds, so we don't do the underlying strategy ourselves. So while I do a lot of macro work on asset allocation within the crypto space, I might do that for my personal portfolio, or it helps drive what kind of hedge funds we invest in. I'm not really a systems-driven person. I'm more of a fundamental macro person. So I don't know how much backtesting you need to do. It depends also the time horizon of your trading strategy. If it's very short term, you probably don't need that much data because you get a lot of data in a short period of time. If it's a longer term position taking model, yeah, it's tricky, right? Because we don't have, ETH is not that long. So you've got Bitcoin only, but the structure of the market changes every cycle as you get more adoption, and volatility over time comes down. So it's actually not that easy to build a longer term model, except straightforward trend following models, stuff like that. But if you get into more quantity models, it's more difficult, I think.
No. Thank you for the view on that. It's a great angle. Raoul, unfortunately, the time has come to wrap up this is actually.
That was quick.
Yeah, I don't want it to wrap up. Again, I wish we can speak a lot more. But before concluding, Raoul, where can viewers find you? How can they connect with you?
Yeah, so I'm obviously very active on Twitter. You can find me there. I'm usually pretty good at trying to talk to as many people as possible. That's at Raoul, RAOULGMI. Then if you want to know about the asset management business, that's Exponential Age Asset Management, expam.com with double A in the middle. And realvision.com is if you want to educate yourself and have these kind of long form, interesting conversations with all of the world's experts on digital assets, macro, technology. It's all there on realvision.com.
Excellent. Raoul, in 1 minute, we got 3 questions. I don't know what happened. Everyone just jumped on the last minute, but just wanted to say that there is 1 or 2 more. Would you mind?
Go for it. Yeah, no, I'm fine.
Yeah, perfect. One question is, if we assume the regulations have already been established, what is infrastructure will TradFi require to open up crypto asset investment ability for an institution or a fund manager. Should I read that again?
Yeah.
If we assume the regulations have already been established, what type of infrastructures will TradFi require to open a crypto asset management arm?
Once regulations approved, I think all the rails are there. Sure, the ETF would be nice. Everyone's been asking for that. But I think most of the rails are there. We've got, large brokerages and exchanges. We have large asset management companies who can custody product for people already, the Fidelities and stuff of that world that they might be comfortable with, they use as their custodian anyway. That's all in place. I think once the regulation changes, the investment banks will fully open up the doors and say, fine. We're lacking a bit of product still, because I think we need the investment banks because they've got more capital on their balance sheets right now. As I said, the space is a bit capital starved. So I think, again, once the regulation goes through, and we're seeing good progress on regulation pretty much everywhere. The US is the harder one, but I'm very encouraged by what the UK is doing, very encouraged by Dubai, very encouraged by Middle East overall. Singapore's done an excellent job. Switzerland, even the EU have done excellent jobs. So we're getting there. So it's coming.
Yeah. What would you say is the future of crypto for the next generation? I think all of us have seen one phase of it, but what about the next generation? What do you think they will say?
In a digital world where everything gets digitized, blockchain technology is the way that value gets exchanged and stored and transferred in a way that we won't even notice. We don't have to see. We're so, because the UX, we're still so early. Everything's so clunky. It's like dial-up modems for the internet still. But really, we won't even notice we're using crypto rails when we make that instant payment to my grandmother in India. We won't know that we're using crypto rails when we're moving an asset from a game to another game. We won't even know when our identity that we log into our websites is actually an on-chain identity. We won't even know any of these things. We won't even know when we buy an equity that it's traded on a blockchain that's sitting on top of Ethereum. We won't know that when we use a central bank digital currency to make a payment for a pint of milk that we're paying. That is where this is going. It's the abstraction away of all of the cryptocurrency stuff and really into how do we change how all of the system of value on the internet. A key thing for most people to get their heads around, which is a much broader topic for another day, is in a digital world, everything goes to zero in value because you can make infinite amounts of it. So that is a problem in a world that's getting more and more digital. How do you store value? How do you make value? And the answer is blockchain solves this. Blockchain allows you to have scarcity in a digital world so you can maintain value. And then when you also figure out that everything human society does is a contract, every single thing, me appearing on this today is a contract, you going to work is a contract, you buying something is a contract, everything we do is a contract. All of that can go on chain.
Yeah, and it's interesting because now I can recall something that Binance Research mentioned in the last report, real world assets, right? Apparently this is where we're all going to see where the focus is going to be at. What is your view on real world assets and applications, of course, specifically on the financial industry?
Well, all securities will go on chain for sure. I think a lot of people want to get real estate on chain because it's such an expensive process of paying different people and slow transfer of deeds and all of that. And tokenization of real estate allows for broader participation from smaller investors. So I think that is very interesting to people. I'm already involved quite a lot with on-chain wine, spirits. We're seeing luxury goods going on chain, digital physical goods, that exchange, that's all happening. In the financial industry overall, I think that entire asset management industry gets tokenized. I don't think we'll be filling out the kind of paperwork and doing the same kind of thing when you invest in a hedge fund in 10 years' time. It'll be an on-chain transaction. So Yeah, it's also, I think, capital for traders, talented traders. They can be retail traders. We're seeing the rise of these new platforms like Enzyme and Covey, where people can prove that they're a good trader. It's on chain, so it's proven. And then, hey, maybe I want to allocate capital to that person. So now you're like seeding a hedge fund industry from scratch by individuals. Now, there's regulatory issues in some places for that. So there's a lot to work out, but it's a wholesale change of everything.
This is a game changer platform. It will really change the game for retail traders who don't have the capital to trade.
Yes, because right now capital is held. Remember the information story of Real Vision? All the financial information was held behind those closed walls, and Real Vision blew it apart. The same is true of capital, right? Capital is the thing that JP Morgan, Goldman Sachs, Blackstone, BlackRock, Apollo, they garner, they hide that away as much as possible, because capital is the superpower. But when you actually see what's in that wall of capital, when you open those walls, that capital is individual pension money, savings monies, individuals' monies. So when you say, well, why do you need to pay those massive firms to do this? Why can't you do it directly? And most of these smart asset managers see that too. So they think, okay, how do we disrupt ourselves? The forward thinkers understand what's coming, which is the power of the individual is rising. And the power of the individual means that these massive monolithic asset gatherers who keep everybody away from the capital except who they want to give it to is changing. So it's fascinating.
This episode is going to be timeless. People are going to see this for ages. Thank you, Raoul. We do need to wrap up now, but I'm beyond thankful for this. Thank you, Raoul. Any final words?
No, let's as I said, generally speaking, you just need to hold on, be careful. If you're coming new into the space, you're an institution or family office, it is volatile. Size it accordingly and lean into that volatility, because it's actually your friend and not your enemy.
Yeah, no, thank you, Raoul, and well, for another episode. You're locked for another episode if possible. We look forward to having you again.
Of course. Thank you so much.
Great. Well, a few of you listening today are DMing us already to know how to apply for the Binance VIP and institutional program. For anyone interested in connecting with us, just please scan the QR code that is on the screen, or you can also email us at vip@binance.com. Both channels work. We can give you more details about how to be part of our program. And if you liked this episode, please tag us, and don't forget to follow us on Twitter and LinkedIn at Binance VIP. And with that, we wrap up today's discussion. Stay tuned for our upcoming VIP Voices. Take care, and until next time.